Hi, Harry here on Friday, June the 2nd for the Rant. And it's the same story here. You know, we had that great first crash, finally confirmed a top back in the first half of 2022, but we've been bouncing since early October, okay? And this bounce has gone longer than a normal, what I call second wave bounce off of a first wave crash. The one back in 1929, which is the closest to this, that bounce only lasted 5 months before it turned down into the next major wave down. I call that the third wave. So we've seen the first wave. We're in this extended two-wave bounce, which now is going on 8 months, about a week or so from now. So this should not last much longer. If it does, we may have to reevaluate. But I'm just telling you, after a bubble of this magnitude and the second stock bubble and second real estate bubble, and remember now the real estate and stock bubbles, the second ones have merged together. The first time around, stock bubble first peaked in 2000, and then the real estate bubble came after that and peaked in 2006. So this is really, bubbles don't bubble up and then move sideways. Of course, I mean, the reason this is happening is everybody expects the Fed will do whatever, even though they did tighten from March of 2022 into May recently, and may or may not raise one more quarter point in June. That could go either way, but they're certainly at the end of this tightening cycle, it looks like. But you do not tighten and not have some consequences, especially in a bubble. And what people are forgetting, I don't understand why more people don't, the 10 to 12 month lag, monetary policy lags 10 to 12 months. So we're not going to feel this March to May tightening thus far, 500 basis points, the biggest one we've seen in decades. We're not going to feel it until around April of this year through, say, May or June of next year, depending on what happens here. So the story is still to be written here. And where are we in this bounce now? Okay, the big resistance was on the NASDAQ, which I tend to watch more closely. It's the more volatile tech oriented index, which means it's more reflective of the bubble of anything. The real resistance was at 13,186 on the NASDAQ. Now note, I keep getting questions about this. This is not the NASDAQ 100, which is even more narrow, okay, and doing even better here, because in questionable times, people just buy the largest cap stocks because it's the dumb money, moving in or getting scared out at this time, okay? So 13,186 was the resistance, and today it went to 13,245 on the NASDAQ. So we may have to give a little more leeway on the upside here, but at the same time, the S&P 500, the broader index, that resistance is about 4230, and then last I looked at it this morning, 4228. So we're right at this. So, I mean, folks, I have to say, you can never tell fully till afterwards, especially in a market that's manipulated. But this is the time. For people who have not gotten out or still have some stocks they may want to sell, this is the best time. We can always reevaluate, and if it looks like it's going to make a run at new highs, which I still think is very unlikely with the chart patterns and everything else, we can wait for a pullback and reevaluate that. But this is the last chance to get out. And remember, also, and I've been saying this for a long time now, the next real support level is way down at the COVID lows. Now, that was just in early 2020, so it's not that far back in time, but that's how big a bubble we've had, okay? So to get to those COVID lows, the NASDAQ will have to be down 59% to the target of around 10,088. So that is serious crash, serious loss of money, and then that's going to cause the Fed to lose credibility, because people still think, that's what's holding the markets in this bounce back here. They think, well, the Federal Reserve will not let the markets or the economy go down too much. Well, if we have this next wave down, which the chart would say is much more likely than people think, and it starts heading down like that, or we get to those levels, then people are going to be scared, and people are going to realize the Fed has lost control. The number for the S&P 500 is about 2190. That is 55% down, okay? And remember, for this to be the crash of a lifetime, to follow a bubble, and even in boom times, the NASDAQ went down 78% when the first tech bubble burst in 2000, 2002. We're going to have to be down 86% on the S&P 500 best target. That's just the early 2009 lows, not that far back. Way lower on everything. So this is when it gets serious. So again, look at your stocks, look at your portfolio. If you're going to make a move now. It doesn't mean it has to be forever. We'll reevaluate if it looks like the markets can move above 13,186 on NASDAQ and sustain that. Again, I think that's unlikely, but if it does, we can reevaluate and we can change again. But I say it's time to get out. Cover your assets, as we say. So again, look for updates as usual, and this is a critical time. And I expect by the next newsletter in July 1st that we will either see the market sustain here and hold, or much more likely start to head down. So I'll keep you updated.